Today, you're going to hear everything about iFAST, one of the legit homegrown fintech companies that I've been a big fan of. They have also been one of the best performers listed in Singapore in 2021. But if you check its share price, it's recently crashed. Why so? And the key reason is because iFAST has sank into the red, losing $2.69 million in second quarter 2022. And that's because of a one-off impairment and tough market conditions. So what exactly is one-off impairment? Will there be recurring losses or not? The second part you'll be hearing about is tough market conditions. What exactly are those? So if you're keen to find out, continue watching on. Hi guys, welcome back. Let's start with the first segment, which is to address exactly why iFAST has lost money in second quarter 2022. That's because of an impairment charge to its India's assets. Now, iFAST has actually entered India's market in 2016, and iFAST India Holdings is an associate company of iFAST itself. And most recently, they've decided to exit its onshore platform service business in India. And because of this whole restructuring, they are impairing the India's assets by $5.2 million. Now, why do they need to exit the India market? That can be explained over here. Securities and Exchange Board of India has announced the discontinuation of usage of pool account for mutual fund transactions as of 1st July 2022. That is the key reason why iFAST is restructuring its India operations. My interpretation is pool account is kind of like a holding account, whereby the funds are temporarily held maybe in the company's name and not in the customer's name. And the regulators just probably want to protect retail investors a bit better. That's my interpretation. But the effect is that iFAST has decided that it's far better to exit the market, and therefore they are taking an impairment charge to the asset value of their India operations. And when I went to look again at previous quarter's earnings, I didn't really find too many mentions of this whole regulatory risk. Just in the previous quarter, iFAST has actually mentioned that iFAST India has good momentum in its business. So it seems like a drastic turnaround in terms of business outlook for the India side. But to us as investors, the key learning point again is when we do stock investing, there is business risk, there's company risk. So never go all in because we are never sure what could change on the business landscape. To answer the question whether this 5.2 million is the start of losses or possibly the end, let's look at some details. iFAST India is actually held as an associate company, which means they own less than 50% controlling stake. For something that they own more than 50% is considered a subsidiary. So if we look in terms of the overall associates, you realize that iFAST total value of associates are only $6+ million, which means 5.2 million seems to be a large part that is written off. It feels like they are throwing the kitchen sink in this write-off, being very prudent in accounting for it. So hopefully this loss is a one-off, and CEO Mr. Lim has actually mentioned that iFAST is likely to return to profitability next quarter. More importantly, they are bracing for substantial decline in profitability for the rest of the year. However, CEO has also mentioned that they believe that there could be a robust ramp-up of profitability from 2023 to 2025. I'll touch on that in a quick while. So with that, now let's answer the second question that you may be thinking of. What exactly is tough market conditions? You know, equity markets have been coming down for the year 2022. And typically when equity markets come down, most investors feel fearful and they convert investments into cash. And that's why there have always been a lot of reports that retail investors and fund outflows happen in bear markets and more so at the market bottom. But if you see in terms of the revenue chart quarter to quarter, you realize that quarter 2 is an uptick from the previous quarter. Everything looks roughly stable, correct? But again, we're talking about a high growth company with a high price earning multiple. We need to see earnings growth as well as profitability growth. This earnings growth is largely attributed to its recent acquisition of a UK digital bank. This digital bank, iFAST Global Bank, in UK has brought in $3.92 million to the overall revenue. However, they are still loss-making. And if we exclude this contribution, the revenue can be seen to have dipped slightly, but that's not the worst. Profits, on the other hand, have shrunk massively. Now, firstly, this UK operations is still loss-making, which means they are a bit like the China operations, going to drag down on profitability, but hopefully one day they become positive contributors. But let's break down as to which segments are doing well and which segments are not. The first is the Singapore operations. You see year-on-year change is decreased by 43.2%. If you check in terms of quarter to quarter, you'd see that it's also dipped marginally. Second quarter was only 3.56 million in terms of profits, whereas first quarter was around $5.3 million in profits. And Singapore is actually where core operations lie. If you look at this chart over here, you realize that Singapore accounts for 71.1% of total AUA. AUA is asset under administration. iFAST's business is in distributing financial assets such as unit trusts, bonds, stocks and ETFs, as well as cash and deposits. As you can see over here, unit trust forms a large portion of the AUA. Now, unit trust actually brings iFAST a lot of profitability. They contribute massively to iFAST via trailer fees. iFAST also earns from rep fees and platform fees for any investment assets that's held within the platform. And in total, these three fee structures contribute about 2/3 of total revenue. If you're new to iFAST's business, I would also like to highlight, iFAST also makes commission income. As you can see in this blue segment as well as this orange segment. These commission fees are typically non-recurring, which means they are when people buy funds with a sales charge or when they buy stocks with a brokerage charge. And iFAST actually derives AUA from two key segments. The first is the B2B segment. That is actually where I work with private clients and build portfolios for them. So if you're keen, look for my links below. The second is the B2C segment, where a key component of it is actually FSM1. And to understand iFAST's business, this picture says a lot that you need to know. Let's look in terms of the recurring net revenue. You realize that the B2B segment is very stable, correct? Year on year, there's positive growth to things. Which means also the B2B side tends to be more sticky. iFAST has a stronger business mode in their direction. When advisors like myself partner with them, we are usually looking for long-term business and we advocate for clients to invest for the long term. If you see for the recurring net revenue for B2C, you realize that it can fluctuate quite substantially. Previous year, it was massive positive, and then right now, it's negative. Then we look in terms of the non-recurring net revenue. That's usually when there are brokerage charges. You see again that the B2B is a lot more stable. The swings are definitely not as big as the B2C. This tells you that B2C trading is a bit more volatile or fickle. When times are good, people trade a lot, invest a lot. Therefore, in financial 2020, you see a massive jump in non-recurring net revenue. But then in first half 2022, that has plunged massively. And for B2C, there's always a lot of competition. And one of them is today's sponsor, Webull. Webull is a low-cost broker, especially if you're looking to trade US stocks and Hong Kong stocks. They are quite possibly one of the most competitive ones. I've been using the platform, and right now, they have actually a referral incentive that you can get yourself free stocks. So scan this QR code or check out the links below if you'd like to sign up for a Webull account and get yourself some of these freebies. I'll also leave towards the end of this tutorial a walkthrough of how you can actually do the setup and how simple the Webull account actually is from the user interface. So let's draw back to analyzing iFAST's operational numbers. Let's talk about the next segment, which is actually Hong Kong. Hong Kong is the one that has seen a year-on-year growth in terms of profitability, correct? If you haven't been following iFAST, one key thing to note about it is that it has won an e-pension service contract in Hong Kong, and that service contract, it's a bit like managing CPF investments in simplistic terms for our local context. And that's actually where CEO Mr. Lim sees a lot of profit growth. The group has stated an assumption of contribution from this e-pension project that will begin from 4th quarter 2023. And they've actually set aggressive growth targets. As you can see over here, they believe that this could multi-fold in the coming years ahead. Personally, I think this is a big business risk for iFAST as a group. If they really execute it well, don't be surprised if next year I launch a video that iFAST could be the growth stock of 2023. So if you're keen to stay tuned for that, smash the like button and smash the subscribe so that when it's released, you get a notification of it. So the million-dollar question, is iFAST a bargain or a falling knife? At this moment, I think it's hard to argue that it's a bargain because earnings have contracted. That is true. iFAST is a highly cyclical business, which means when equity markets are tough, typically they see a drop in terms of earnings. But when markets start to swing up, that's where their services naturally benefit. And I intend to cover iFAST a bit more. If you're keen, check out the members channel Over there, I'll leave deeper thoughts to this whole discussion because as I mentioned, this could be one of the growth stocks to look out for 2023. Join the members channel and all proceeds from there will be donated to NTU via the JOSH TAN Bursary. And since you stayed to me to the end of this whole tutorial, let me share with you a bonus point. Something that I've discovered looking through the numbers. I don't know if you work in CBD or Raffles Place. On the ground, it's quite obvious that wages have climbed quite recently in the recent months. And when I was trying to piece on what the various stories are trying to tell me, it feels that the employment pass holders in Singapore seems to have shrunk and that there are a lot of promotion opportunities for locals. And that's why we see the fresh grad pay higher than ever because anyone in the 30s would have easily been promoted, which creates a vacuum for everybody to derive a higher pay. But what I want to highlight is that iFAST has also experienced a massive increment in terms of their staff expenses. Staff costs excluding equity settled share-based payment transactions have increased by 40% year on year. Now, are these increments temporary or not? I think one of the best guesses is to check out what the banks are also paying, and they will actually be releasing results in the next few weeks ahead. So if you're keen as always, smash that subscribe and stay tuned. When our 3 major banks release results, I'll share them with you. Thank you for watching till here, and with that, let me invite you to my previous tutorial on Webull. Check it out, and if you are keen to invest in banks, check the second video out. Invest safe as always, and I'll see you there too. Take care and goodbye.